All right, we're gonna start this up again. My computer just restarted. Nice. All right, let's give everyone a few minutes to get in here again. Just to recap, I'm in a scalp short. Might get stopped out here. It's trying to reject a little bit, but I want to go over this order flow from yesterday. What in the heck? But the idea here, we're going to look, somebody's asking what the main idea is. It's just fading these aggressive longs into these local highs. We'll see if we can rotate back to these lows one more time, where I might be looking for a long setup. But anyways, let's recap the order flow really quickly yesterday, and then we'll get into the live charts. So, as some of you know, I was looking for a long setup taking this low here, and I did end up taking that long setup, and it did end up not working. I had to go. I had updated all day that I had to leave at a certain time and I'd be gone, and it came right before I left, this wick here. But as we were forming into this low, we noticed some bearish absorption in the order flow. You know, we have 53 million in aggro longs here. By the way, I don't think the scalp short setup is super likely to work here at this point. But anyways, we noticed some aggressive longs up at the highs. I mentioned at the time that this is the kind of short setup I would take. We had a bit of a range forming just into the local lows, sweeping those local lows. We wiped out a lot of that liquidity at the lows, 43 million, 47 million, 29 million, 85 million negative delta when we broke down here. This is when I was away from the chart. But we'll notice something. After we have this initial breakdown, a lot of delta flushed, but a little bit more bearish absorption into the downtrend, another flush of all this liquidity, and then aggressive shorts closing, aggressive longs opening, and into this uptrend we just start forming more bearish absorption. Price making lower highs, CVD making higher highs, really aggressive longs up at the top, 17 million, 28 million, 42 million. That gets flushed out. We see all those, that negative delta now, decreasing open interest, some shorts opening, more aggressive longs starting to open, a little bit of a bullish divergence here as some positions closed, 32 million. So what I want to point out is that oftentimes, we're not always, sometimes you're seeing some aggressive longs coming at the lows, but we're seeing these really aggressive market longs or market buying, sometimes it's shorts closing, sometimes it's longs opening. We can look at the open interest up at the highs, and then we see all this market selling at the lows, typically, right? So we're seeing peaks in market selling at the lows. You could say the low comes in maybe because of the market selling, but you see really aggressive selling here, 15 million, 12 million, 42 million down at the lows. Get one nice aggressive long there. See some aggressive buying come in, some of those positions wiped out. So this is what I want to kind of note here. Let me just make sure I'm on the right page. Is we see this 27 million aggressive long open after these lows form. We see a nice reaction, but it looks like that position's still a bit of a target, right, for price. And even something like this for a lower high, coming and wiping out some of that liquidity that's building up is kind of a nice idea. So you see the aggressive long open, he's happy for a few minutes, and then price comes down negative 20 million, negative 9.5 million. And so just because there's an aggressive long at the lows doesn't mean, or at the highs, doesn't mean price has to come down immediately. But it's a nice idea to keep an eye on where that liquidity is resting, which is why I think coming back and retesting this low could be a nice idea for a long. Wipe out some of these longs building up, get maybe a bullish CVD divergence, a nice scalp long idea there. Major liquidity ideas up here as well. But yeah, really looking to consider fading the really aggressive longs at resistance if there's signs of weakness. It's not always going to work. Wouldn't be surprised to see a retracement here, but right now we are kind of breaking out more aggressive longs coming in. So let's just, so what I want to point out is that it's not just about shorting or longing necessarily every time there's negative delta or positive delta. You still kind of want to have a technical, structured setup, because just because some aggressive longs come in doesn't mean price can't go higher, but you might want to be wary. Like I'm quite certain I saw quite a few Discord members short this yesterday, and I think the idea here was just shorting into, I go to the trading view chart. I'm almost certain this is what I saw in the chat, people shorting. Sort of similar to this setup I just tried here. Go to the trading view chart. Just into this SR flip. So we have support forming here, a breakdown. Price breaks down. At the time, this is our new GP retracement, the 618 retracement from high to low. Price retests the SR level with all of this. Let me go to order flow here. With all of this aggressive market buying coming in at the highs, increasing open interest, 28 million, 42 million in this last candle right at resistance. And then you have the really nice technical confluence to flip short go to the trading view chart to maybe you had long ideas here at support, but to flip short on the retest with a nice nice order flow confluence there. So I think the important context here is that we're forming a range that could break up or break down. We have some resting liquidity up here, but we are forming bearish divergences on these impulses to the upside. Even here, this is still a bearish divergence. We didn't get that clean kind of GP rejection there. We could easily push up and take these local highs, but typically you're wanting to consider the idea of a lower high with a bearish divergence. That's sort of the idea, right? Like something like this SR flip into this level with these really aggressive longs coming in right at the end. To short into that, you're not really necessarily looking for the, especially for a scalp short here, for this high to be taken, because you're kind of paying attention to the really extreme absorption here for a lower high. I'm gonna answer some, or I'm gonna break down order flow ideas a little bit more here because I think there's a lot of misconceptions. I'm gonna read through some of the comments. I saw one that I think is gonna be important to answer here. We heard you say, oh yeah, you heard me say my computer crashed right before the stream ended. I might take a look at some alts later, just reading the comments. So that question I want to answer is, someone says, hi Lucky, why always when there's big longing volume comes in, you would choose to short it? Shouldn't the volumes push the price higher? So this is I think a big misunderstanding in order flow, and I think it's because a lot of people don't really understand what the interaction of the market is. But these aren't just longs opening; these are shorts opening as well. But when we say aggressive, when I say an aggressive long and an aggressive short, I'm saying at market. But there's always has to be a seller for every buyer, right? So when open interest is increasing like this, and you see 4.2 million, 5.3 million, 10.1 million, that's 10.1 million market buying, and you can infer it's a long because it's an increase in open interest. So this is a long opening at market, but you can't just open long into market into thin air, right? There has to be, for you to buy, someone has to sell. For you to sell, someone has to buy. So what we're inferring with this idea of kind of bearish absorption is kind of more of a technical term. It doesn't have to end bearishly. Is that there's limit sellers here selling into this, but they're shorting into it. And how do we know that? Because open interest is increasing. So you can think of it like this. There's two traders here. There's a limit trader and there's a market trader. The market trader is buying this breakout aggressively at market, hitting market buy, market buy. The limit trader is sitting here with limit sells and shorting into this. And you know they're filling shorts because open interest is increasing. So we have long risk coming in and short risk. The limit seller is taking on short risk. The market trader is taking on long risk. And sometimes you have big increases in positive delta on a decrease in open interest. So that it's just the inverse. Risk is coming out of the market, risk is going into the market. You have aggressive traders, which is what CVD is showing you, those trading at market. And then you have passive traders. So I want you to think about something for a second. And this is the idea of like absorption being, considering something as bearish if, because for price to move up, you're right. The thing that moves price is market orders. The thing that stops price from moving is limit orders. So for example, if there wasn't a big seller here and 80 million longs open at market, well, if there's no limit orders resting here and somebody hits market buy, price is just going to shoot up, right? Because no one, until there's a limit sell order willing to take the other side of the buy order, price is just going to keep moving until it's filled. But what happens, so for example, it doesn't matter what I do with a limit order, it's not going to change the dynamic of the market. I mean, it will in an indirect way, but if I put a $70 billion sell order here and price is trading down here, people might be looking at that sell order and be like, okay, I don't want to long into this, right? And then I could pull the order, whatever. But that's not moving price. It's having no effect on price. Price is interacting where it is, market buying, market selling. If somebody market buys, price is going to keep moving until it's filled. If there's a lot of market limit sellers here, then price might not move at all, right? Price could not move at all if somebody market buys 50 million and there's a 50 million limit selling order here, and price could just fill and then reverse, right? If it fills and there's like stacked limit selling here, it's going to keep ticking up until it's completely filled, and then price is traveling down. So essentially the idea here is, what kind of trader, there's two kind of traders. There's somebody willing to sit here and fill limit shorts. So they're not reacting to the market here. They're just sitting here with limit shorts, trying to hold price and push price down. And as price pushes up into this liquidity, we have another type of trader who's saying, whoa, price is going up, price is breaking out, I need to get long. I need to get long now. And so they're market buying. And they're that kind of reactive trader who's trading really aggressively, saying, get me into a long position right now, price is going up, is trading against the passive seller who's saying, I'm going to sit here and just fill 50, 60, 70, 80 million dollars in shorts on this one pairing, right? And so they're just sitting here filling short positions. And typically the bigger traders that have more confidence in their ability to affect the direction of price are trading with limit orders, right? So if I'm a big trader, I might want to sit down here and fill limit buy orders, and I also might want to sit up here and limit short. And so what I'm doing is every time price comes down to support, I'm filling a bigger long position. Every time price is coming up into the highs, I'm the same trader limit shorting and just building my long position down here. And every time this liquidity comes in for these market buyers, I'm using that to fill my short, and then I'm using it to offload into the lows, right? To fill my long position. And that's how a range can form, because you can't, if you want to build really big size, you can't just market order into, you can't just say, I want to open a $500 million long position here and just click market buy. Price will just go straight up, your slippage will be insane. You know, that's how you get those insane wicks on some exchanges. And so you need to use limit orders. So when you know that the types of traders who, and the types of positions they're wanting to fill, the types of traders that use limit orders are the really big traders who are looking to push price into liquidity. Well, you start looking for signs of what are the limit traders doing? What are the traders at limit doing? What are they willing to do? And maybe it's a bit of a warning sign. It's like here when you have a $53 million long, you could say, ooh, whoa, this guy's really brave. He must know something that I don't. Or why would he open a $53 million long at market? He must know that price is about to go up. But think about the person that's just willing to passively sit here and fill a limit short $53 million, right? So it's not to say that necessarily one knows more than the other, but don't discount the type of trader who's just willing to sit there and absorb tens of millions or hundreds of millions of dollars in market buying and market selling with limit orders, and what their intentions might be. And we're going to notice a trend if we look at order flow, which is really aggressive longs up at the highs. Here's we covered this live too, but 78 million, then followed by a $62 million wick here, negative delta. But we have this aggressive, I pointed this out over the weekend. I didn't short it. I kind of, maybe a little bit of regret there for not shorting that, because this was just a huge bearish divergence. I said, if it wasn't the weekend, I probably would short this. But I was going to wait till after the weekend played out. But we can see this big bearish divergence forming between price and CBD. We see lots of longs opening up here. You know, let's look at this breakout above 65K. It's just sort of like a general idea. A lot of aggressive longs opening on the initial breakout, but over the weekend, this whole breakout could be considered a top. You know, if we want to look at it as a daily candle or a sequence of daily candles. Look at the order flow. What are the aggressive traders doing? Market buying. Here we have a big market close of a short, but it's still market buying. 26 million positive delta, 25 million. Yeah, we had some selling on some of these local pullbacks, but predominantly market buying, 20 million, 25 million. Increase in open interest, 11 million, 11 million, 5 million. These are 5-minute candles. I'm not saying we didn't get any selling, but we're going to look at what the term CVD means. It means cumulative volume delta. And so the cumulative volume delta up here, 5.4, 5.5, 5.9, 17 million, 7.2, 6 million, a little bit of selling here, another 8.3 million, a little bit of selling here, because there's going to be people in here trying to long with tight stop losses, right? Big leverage longs, getting stopped out on little pullbacks. 16 million, 21 million. This is all at the highs above 60K, 8.6 million, 5.3 million. And so what happens is as price ranges here, our CVD, our cumulative volume delta, is really positive. And this is just to say that there is more market longs opening here than market shorts. And there's a lot of market longs opening between this high and this high, and we could actually calculate how much that is. If we go down into these lows, we see here we have our individual delta in the candle, and we have our CVDs, which is our cumulative volume deltas. And we can see it's increasing, going from 31 million to 57. It depends on the session you have it set in on when this resets, but 107, 116. And we see as price keeps ranging, it's 168, 174. So we've accumulated 130 million CVD between here, 31 million, and here. So this line, this CVD line, is just another way to represent that we're accumulating a lot of market longs relative to the market selling. And then the question is, if that's the case, if there's so much market buying here, so much market longing, because like you said, shouldn't aggressive market buying be the thing that moves price up? It should be. But then where we have to scratch our head is, why isn't it moving up, right? Why isn't price having an easy time moving if there's so much market buying? Why is price making a lower high while CVD is making a much higher high? Because this is a sign there's big limit sellers selling into this aggressive buying. So the same thing goes, you see the big spikes in CVD, right? Like big spikes on these kind of horizontal breakout ideas. And then some of that liquidity wiped out, big spikes. So people want to aggressive traders typically want to long aggressively into breakouts and short sell aggressively, or buy aggressively into breakouts, sell aggressively into breakdowns. Sometimes that's just stop losses, right? It's not always like this right here. These are shorts getting stopped. 42.5 million positive delta, decrease in open interest. This is market buying, but it's not people opening longs. It's people getting wicked out of shorts before continuation to the downside. But yeah, so that's the idea. Is like right now, there's a lot of aggressive buying coming in. You could say it could be bullish. It could be bullish if the traders here willing to sell into this aren't big traders that can hold price down. But we're seeing signs that somebody wants to sell into this, right? If they didn't, price would maybe be having a little bit of an easier time moving up through this level. And the more extreme the divergence gets, the more confident you might be that I might want to trade along with this really big trader here, because do I want to sit on the same side of the trade as the people longing into this 65K breakout and getting absorbed by a really big trader? But this is something I want to point out too, is we saw actually quite bullish absorption off of this low, which is a long setup I had targeting this breakout, but I missed it because I was sleeping, but I did share it. Some people got into it. But after we formed this low, we're seeing the reverse. So for some reason, before the breakout, and I could probably just guess, I don't need to guess, but I will, just to kind of form some general context, is as prices selling into or rallying into these local lows before we broke out of 65K, we actually see aggressive selling, right? So we see CVD, like really aggressive selling, and probably some people are thinking at this point, we're going to just put in a lower high. Like everyone thinks we're going to break out. Maybe the aggressive traders are like, I'm not going to fall for this. I think we're actually going to put in a lower high and maybe have a big rejection. So I'm going to short the lower high. Or whatever the psychology is, you don't really have to think about it too much. You could just imagine what it might be. It doesn't matter what their reason is, because we see that they're doing this in this uptrend. So what's happening is the inverse. Aggressive selling, CVD is making lower lows relative to price, but price is making higher lows and carrying higher. Aggressive selling, getting absorbed. Aggressive selling, again, CVD is making a new low. So what do we infer from this? If all the aggressive traders at market are wanting to sell into this uptrend aggressively, and they are, but price isn't going down Well, the only way that's possible is there's big limit traders pushing price higher, absorbing all of the selling pressure into the breakout. So here is called a bullish divergence. Why is it bullish? It's just a name for it, but it's considered bullish because it's just an evidence that there's big limit buyers here trying to hold price up. And then it starts to get bearish up here as CVDs now the aggressive traders aren't wanting to sell into this. Price is broken out, they're longing into this, and now we have a bearish divergence, evidence that a big limit seller is sitting here to sell into this. All right, let me read through the comments really quick and see if this is making sense to anyone. There's not really any new comments. Someone's saying, okay, I'm just wondering what gives you the indication that on large candles the open interest is one-sided, as it can also be longs and shorts opening. Well, it's clearly not going to be, in most cases, it's not going to be simply longs opening or simply shorts opening. There's going to be some positions closing, some, like for example, if we get into the lower time frames, like we could start dividing up the positions, right? Like we see wicks. So you can see wicks in here, which means open interest is increasing and decreasing within the context of the candle. If we go into the 1 minute time frame, we could start seeing dividing up even further where the long positions, where its positions opening, where its positions closing. But if a candle is just all open interest increase, that's risk coming into the market, right? So it's going to be longs opening at market, because we know there's not no market selling into this. There's going to be some shorts opening at market too, right? We can divide the we can see in the candle profile here, these are market buys, these are market sells. If we zoom in really close, we can see 1.4 million market buying at this price, 689K market selling. So there's market buying and market selling essentially in every single candle. Some candles are predominantly market selling, like this one, 8.8 million market selling. Some are predominantly market buying, and you can see it in the profile. But here we can see when we add it all together, it's 10.1 million more. It's a 21 million volume candle and 10.1 million more market selling than market buying. And it's an increase in open interest. So there's going to be predominantly, this candle's going to be predominantly positions opening, putting risk on. I mean, so this is kind of interesting here. Like into these local highs here, we're having just now a big long position opens, right? So there's 0, 0, 0 on the sell side, but we have a 6.1 million long position opening. Big increase in open interest, so risk coming in here. It appears price is claiming a breakout here. If we go over to the trading view chart. So let's just kind of get into the minds of the traders that we're watching here. And understand there's two. I mean, hey, this looks kind of bullish. I mean, price is breaking out. Price is claiming this horizontal. It's retested it as support. It's about to, it appears like it's about to break out of this. There's probably a lot of traders thinking, hey, we're at least going to go up to here, and I think we're actually just going to break out of this downtrend. I want to get long, right? We're just kind of getting to the mind of what's the thesis here for going long. We're going to look at the order flow. And yeah, so people are wanting to trade this breakout, right? It looks structurally kind of nice. So why would anyone want to long at market? Why would a 6.1 million long want to open here? There's another 6.1 million long slightly before it. Why would shorts maybe want to close? Because structurally, we're showing some signs of strength, but this can get kind of trappy, right? Like maybe we wick this high, maybe we run the last of the liquidity of the shorts, and then maybe we retrace. So we have the trading view context here. I'm not saying we will. Maybe we just run up to this target up here as well. I'm not saying this is a ridiculous long, right? Let's just get into the mind of what this trade out is, or trade setup is, which is a breakout, right? Price is starting to break its downtrend. Maybe we went lower high, lower high, lower high, lower low, lower low. Now it's like higher high. But we're also in a range. All right, so let's get back to order flow here. So as price is kind of grinding up here, this is what we're just going to note. Let's just look here. Since here, we have a lot of market longs opening. 15.3, 10.4, 9.9, 4.8, some shorts closing at market. A little bit of market selling here, some positions opening on this little pullback. They're opening back up here, 4.2, 5.3, 10.1, 6.4. A little bit of market selling here on this little pullback, but aggressive longs again, 4.3. So, but what's happening is, we can imagine there's lots of long positions in slight profit here, just locally. Targeting this breakout, we're about to tap this high. What would I expect to see if this high gets taken? So I'm going to say a couple things. One, price can break out. Price doesn't have to range. It doesn't have to reject here. We could have 100 million delta positive candle. Price could just break out straight up. Shorts get squeezed. More longs come in and price just goes higher. But a lot of times price is ranging. And ranges really, really hurt people. Traders like ranges because they form all the time. And even if you end up taking some losing trades in a range. Typically a range has really nice asymmetric risk reward, right? So you could win 2 trades and lose 2 trades and do really well, or win 3 trades, which typically you should be winning a few extra trades if you're trading the entire range. And then you lose a trade when the range breaks up or down. But when we take this high, what I'm going to expect to see is probably some shorts stopped out. So we've had some shorts stopped out, but look at down here, we had some aggressive shorting at the lows, some wicky negative delta. Some shorts have been accumulating in here as well. And a lot of those shorts are going to be shorting with their stop above this high. So at this point, we're pushing up into this liquidity. Wouldn't be surprised to see a wick up here, big positive delta spike. Now, if it's a huge positive delta spike like this, like 50 million, 60 million, and then price just wicks down, I mean, for me, that's a scalp short trigger. It's just the idea being we've tapped that liquidity, rotate back to the lows, and invalidation is just a breakout, right? Price is either breaking out or it's not. And like I covered this kind of short idea earlier. The idea here isn't you're taking a short because you know price will reject. You just know when price isn't rejecting. So you have your kind of invalidation, right? But yeah, the idea here of the longs at market, I think is pretty straightforward. It structure looks kind of bullish, reclaiming this downtrend, and we have some nice liquidity resting up here. But what can happen a lot of times for these breakout trades is, like, a lot of times somebody would say, well, they're long here, like it was obviously a good long. It's a good long if they're not constantly, if they're targeting this high, right, and we reject. Like, if you actually go look at the order flow, a lot of times price will go a little bit higher than where a position long, like here, 27 million. This was a short closing. But they're just round tripping. So they just become that kind of resting liquidity, grinding uptrend, more longs opening, then they all get wiped out altogether. So, for example, if we do reject here, you're typically not ever going to see these longs, evidence that these longs are closing into these highs on a rejection. You're just going to see longs building up and then everything get round tripped. Typically, not always. so just to kind of drive the point home on a little bit of a higher time frame, some amount of longs are opening into this uptrend and even into this range, right? Some amount of longs. We see CVDs in the context of this range has made a new low. How many of these longs? I'm not saying that there's not a case for just having longed in this range and you're holding for all-time highs. But how many of these longs do you think at some point said, hey, I made a really good trade, look, price is going up, but it doesn't really matter in the end? How many of them do you think just got washed out? They never took anything off of it. And how often do you think there's evidence that that's happening in the order flow? That even when people say they long up at the highs here, I mean, there's a lot of evidence that this really bearish absorption, these traders were getting stopped out. A lot of them were. But even if you hold through this whole retracement and you wait for the breakout, I mean, a lot of these traders they're not longing to target here, right? They're not longing to target the fake out. They're longing to target the big breakout, and they just end up round tripping. And all that liquidity is just resting here to be taken later. So Zepha, the question is, your thesis still that we see lower eventually? Question mark. I have a lot of theses. They have invalidation. Like I could say my thesis is here that it looks like we're in a range, but if we break out of the range, then that's not my thesis anymore because we're not in a range. My thesis. I'm actually gonna pull this here. The idea for let me just get rid of a bunch of stuff here. I go over the trading view. I think it's really important to understand the context of an idea, and that for me, I'm not married to this idea. Although I would like to see a little higher because I didn't short that on the weekend. Okay, I'm going to come back to order flow really quickly. But the context of this idea was, hey, we're in this choppy downtrend. Keep in mind that here I was looking for 42K, but even though I was looking for 42K, before I was looking for 42K, here I'm not saying, oh, we're going to 42K right now. I'm saying, hey, we're still in a range. Ooh. I'd like to see something like this. Price push up into the point of control. We form another lower high. We reject, take these 50K lows, form another lower high. So just to say, like people are saying, I've had the 42K idea on my chart for a long time, even way back here months ago, but I'm not saying 42K is coming tomorrow. My primary thesis here was a push up for a lower high. My primary thesis was maybe a move down through the 50K liquidity, another lower high. And my thesis here was form a higher low, take this local liquidity, and then the appearance of a higher high. And that was my primary thesis before the move down. So just that context is important because people are really dumb and they don't pay attention to the idea that a major target at 42K is a nice idea, but they'll say, you've been a perma bear. Even if I've been looking for the move up to 67K, looking for this, looking for a fake out of a higher low at 55K was the level to reclaim, and then faking out the higher high. So I'm not a perma bear. Like I'm thinking longs are the setup here up to 67K. So that's the first thing. My primary thesis, if we are failing to break out of this high with a really nice technical target being the point of control at 67K, and I think there's a lot of opportunity to wash this level a couple times to trap people, we may or may not. If we are rejecting from this, my primary thesis is 42K, is a breakdown of these lows, taking this liquidity before a move up. if we are breaking out of this level, that's not my primary thesis anymore. Okay? And so what another thing people get confused about is they think that if you think price, you trade just based on where you think price is going to go. So if you think price is going to go to 42K eventually, you open a short here. And then when price is way up here, you just hold it and you say, you know what, I have a high conviction that we're going to go to 42K. So I'm going to just sit deep underwater here as price just goes straight up. No, you might miss the short. You're not shorting for 42K here and holding through all of this. You're shorting at resistance still. If you don't get the short, you don't get the short, you look for the long. So that's the other important thing. Somebody commented on my Twitter the other day that I got everyone wrecked on FTM because I thought I said we were going to make new lows at 16K. He said new all-time lows. It's not actually an all-time low, but that I posted up here that price, when price was at $1.20, this idea of a big ABC correction down here. But by the way, I did post here that we have this channel, the 786. I'd be looking for a rally up into the middle of the channel. It's 180% away. I actually do want to cover this for a second. Have we taken this high yet? No, we're still front running it. I'm going to go to order flow in a second. Nothing new is happening. There's no big positions opening. I'll tab over if it does. But this is a 180% rally on FTM. And this is what I want to say here for a second. So if somebody said I got all my followers wrecked because I thought price was going to go down to here and it only went down to here. So basically, price went down 81% and you thought it was going to go down 86%, 87%. You got everybody wrecked. It's like, no, unless you are an absolute fucking idiot, which this guy might be, because his first comment to me ever on Twitter was months ago saying, oh my gosh, is the bull market over? All my alts are down 80, 60, 70, 80%, whatever it was. And I think it was a comment on this FTM post maybe. Okay, so I'm just kind of inferring, if your first comment to me was months ago saying, all my alts are down 80%, and then I'm saying I'm looking for this, I'm going to show this in a second, and you short here looking for this last leg of the move, and now you're saying, oh, I'm wrecked. I'm not shorting down here, targeting this. What's the invalidation, right? So then months later, he says you got everyone wrecked, calling for lower on FTM. No, I'm calling for this 80% high, price dropped 80%. I'm not shorting down here the first time you saw my Twitter and you're like, oh, I bought here, now I'm down 80%. I'm going to sell here. Maybe I'll short here to the last leg. So, yeah, I mean, you're still trading levels, right? But this is what I just want to show here for the, I got quite a few comments that I'm a perma bear. I just want to show something. And because this is really important. Because it's the context of the idea, right? I'm not saying I call everything perfectly, but I am saying that, like, there's a big difference between shorting and looking for shorts up here at resistance. I think this was a GP retracement, whatever it is. I think this was as well. Initial rejection, perfect 618, blah blah blah. It doesn't really matter. But this was my update on FTM down here. It said, I want to update FTM here. This is months ago. We are bouncing off a major parallel structure right at the 786. I won't be surprised to see a major bounce here. And it might be a bit of a disappointment if we don't take those major lows. Major resistance sitting at the middle of the channel in the 0618 in my view. And then what do I draw? I draw a straight up line to the middle of the channel in the 618 at 70 cents, right? So what I'm pointing out here, am I a perma bear? Am Am I just married to this idea of this low coming in? When I'm saying my primary thesis is another 150% from here, 180% rally from the lows. Give me 1 second. Yeah, sorry. To respond to this. Okay. So anyways, I just want to point that out, that this isn't a perma-bear thesis. This is a major bounce from here. People would think this is insane. No way. Most people would say, no way. Look at how bearish this is. We're not going up 180% here on FTM. Sorry, I've just got to finish. Okay. And the same thing, you know, it's like we're on the 15-minute here. Basically, I'm willing to long with invalidation every retracement on XRP. Every technical retracement that I can find. I'd really like this idea too. Probably look for longs into that. But I have longs down here targeting all-time highs on XRP. I know that's a little bit memey to some people. I like the idea. I'm targeting all-time highs and longs on Doge. I'm long, swing long from here on INJ. I've been sharing this idea all year. People thought I was insane, perma-bear, up at the highs, perma-bear for thinking $14 could come. I updated this like 1,200 times in the Discord and on Twitter. I updated that I was taking this long. Actually, updated I was taking profits, and I back to the long on a retracement too. But it doesn't matter. The point is, I'm not a perma-bear. I'm just not longing FTM here. This is where I want to be looking for shorts that may or may not work. I'm not longing INJ after it's up 70% as my swing long. I'm longing it down at support. And so anyways, and I'm looking for much higher. I have longs on Say from much lower, looking for up here. I'm in those longs. So, but people want to call you a perma-bear. My primary thesis on WIF, was 130% rally from here. But now I'll be getting comments from people that I'm a perma-bear when I'm looking for this short on WIF after the 130% rally. Right? So anyways, but no one says anything if you have long interest at support, but apparently you have to have it after the 200% rallies. All right. Okay, let me just read through these comments really quickly. Yeah, so someone just saying that they know. They say I'm just curious what you think PA will look like, knowing damn well you could be 10,000% wrong. Yeah, like your gold chart from 2 years ago. I think my gold chart was 10,000% right. So maybe I'm misunderstanding that, but you can only be 100% wrong, which is good. Any chance of looking at SUI? Maybe, we'll see. No, I don't want to make this. I don't want to make this like a full recap of like every educational concept. I want to keep it mostly bell order flow, but why short if Bitcoin going to stop loss? Always a good question. Why short if it's not going to work? Why would you take a trade that's not going to work? unfortunately, you don't know until after you take the trade whether it's going to work or not. We can take a brief look at order flow here again. Prices coming up here, retesting this wick, retesting resistance. Nothing too crazy happening right at the highs. 6.1 million here, a close here, price chopping around. I would say that, you know, like right here, there's really nothing you have to, like for the bearish case, locally, you don't really need anything else. Like price doesn't have to even wick through this high. You already have a bearish divergence. Price making an equal high, CVD making a higher high, liquidity building up. Maybe kind of nice to get the scenario of like a wick through the high with a big trap long or something like that. But price either kind of rejects in the context of this range or it breaks out. There's really no way to know. But you do know, you're just observing data, right? Like if you wanted to say, for example, you know, price, this is like, it's like this. Price is coming to this, testing this SR level at the GP, and $70 million long just opened at market. Some people will hear that and say, you said price was gonna go down. But that's not what you're saying. You're observing facts. This is factually this technical retest, and there's factually a shit ton of longs opening here, right at this structural resistance. It's not a claim about where price is going to go. It's a claim about facts, and then you can decide if there's a reasonable trade to put on based on those facts and how you'd want to invalidate it. Understand there's no way to predict what's going to happen, right? There's aggressive selling at the lows, you know, whatever the setup is. It's not a claim about where price is going to go. It's a claim about objective facts that you're trying to use to shift the probabilities of a trade in your favor, knowing there are no certainties. It's a holiday today in China, but this Chinese trade is absolutely absurd. Sort of steals a little, it doesn't steal a little bit of my attention. It steals a little bit of my, or I guess it gives me a little bit of emotional dopamine basically every day, just going straight up since I got long. And so far, no, testing some local highs here, but so far not even a sweat, just the entire Chinese stock market up approximately 30%, and some of the index funds that I'm trading up much more. But expect it to have to cool off a little bit, but hey, if it's not going to, great. Oh, I wasn't even on my trading view chart. Yeah, as far as the SPX goes, I mean, we're obviously testing an all-time high breakout. We have a bit of a range here, either carry higher, carry lower. My primary thesis is higher time frame, bearish here, and maybe we chop around at the all-time highs and form a new high before a breakdown, or maybe it just keeps going straight up forever. It's always possible. Anything's possible. We'll look at some individual stocks. I wrote a little thread not too long ago, maybe a month ago, going over some of the magnificent seven, as they are referred to, and recently an article came out that it's the most overcrowded trade right now as just being long the Magnificent Seven. We can maybe look at some of those. Just kind of interesting to note here. Can look at Facebook, Meta. Maybe a bit of an ascending parallel structure into the 1.237. Might be due for a pullback. Again, you know, people are going to think all this is impossible. Never's going to happen. Trade back down to our kind of 2023 lows, start of 2023. Retest this level. Hey, maybe. So here's the thing that's kind of interesting about like a bias, is this, even this down into this level, but especially down to this, seems so much more impossible to certain people than this. Like if you ask people what they price can either go up, down, or sideways, right? It can either go up, down, or do nothing. Is it likely that we do nothing forever on Facebook? Probably not, but we could keep ranging for a while. Okay, if we're not going to go sideways forever, price can either go up or down. Maybe you want to start weighting the probabilities and the probabilities of going down at some point a little bit higher when price has just been going straight up. Wipe out some of that liquidity. Maybe use some technical ideas. But for me, there's nothing unreasonable about seeing a big retracement out of Meta. Maybe push up a little higher and tap this channel a little cleaner. Shared this a little while ago. Haven't quite tapped it yet. I have Google. Nice clean parallel channel, rejecting from the highs. Again, I'm not saying price is going to come straight down to this target, but this timing confluence down next summer, back at 125, looks quite nice. Maybe, just maybe, take these highs, finish off a downtrend, maybe can see a little bounce from there. But these are just trades I'm interested in. But if I'm observing all these stocks with nice, clean, structured, technical rejections at highs, hey, maybe I might start looking at some bearish ideas. I want to take a quick look at Apple. Big parallel channel here again. We're going to head over to Bitcoin in a second, taking the highs. 6.4 million short stopped out. Anyways, lots of big technical structures at resistance here. We come run these highs one more time. Amazon's super clean here. This nice parallel channel right into the highs. That's one perspective. The other perspective is a range here. These are the types of places you would like to see a rejection, right? Technically. I'm actually gonna go over to Bitcoin in a second. There's actually a few things I didn't think about covering that I want to cover now. Can go look at Costco too. I did a post not so long ago, and I just said, what the fuck is about to happen to Costco? And the joke is, using technical analysis, like Costco's just been straight up, right? Lots of stocks have. But the joke is using technical analysis to predict world events. And so like the joke would be here on China, for example. You have this, I call it a predictive parallel structure, where you have these lows pulled to this high. This is anchored. It's a perfect parallel channel touch. That's why I'm looking at these things on a lot of these major stocks. And you could say, well, what does a parallel structure have to do about it? It doesn't really matter, other than these are consistently ideas that play out in the market. You could say, ooh, something bad is about to happen in China. Ooh, something really good's about to happen in China. And And in a way, you're looking at these technical structures, you're not actually using them to predict, you know, geopolitical events and macroeconomics, but you could. The idea is kind of there, right? These liquidity ideas, and the question is, like, does the chart shape the news, or does the news shape the chart? And you could make an argument for both, but nice little rejection at the highs here on Bitcoin. Don't really need, we're going to go over to it in a second, but the same thing here, right? We're just looking at the British pound versus the dollar. This big weekly range, monthly range. The highs get taken. Ooh, something bad's about to happen. Sweep these major highs, retest them as resistance. You have a big economic crisis, price goes straight down. Price wicks the lows of the range. Ooh, something good's about to happen. Like, you could put these taglines within these technical structures, right? But anyways, let's go back to Bitcoin. We're just looking at the same kind of ideas on the lower time frames as looking on the higher time frames on those other charts. We've wicked this high here. Don't really need anything else for the bearish case here in order flow. Like, we already have it's considered a bearish divergence here. Lots of liquidity building up below. I mean, this scalping these structures, these highs, these highs, these highs, it's pretty straightforward. It's just, is price rejecting? It's a scalp, right? You're not looking, you're not checking what the next, you know, Powell speech is and what the forecasts are for the next 10 years of economic data. It's a scalp. It's on the 5-minute chart. Is price breaking out or is it not? Can I size this in some reasonable way so that if it does break out and my trade doesn't work, it doesn't really matter, and I can just take another scalp 10 minutes later, 20 minutes later if I want to, with asymmetric risk reward? Yeah. Could I even invalidate it super tight, but maybe not risk 20% of my trading account on the setup? Maybe I just want to risk a small fraction. Maybe I want to risk 0.2, 0.1. What's the point of risking 0.1? Hey, I'm scalping. Maybe I risk 0.1, I make 10R, and I make 1% on this scalp. That's not worth it. You risk 0.2. The point is this: if you're not comfortable, you should be sizing your trades to such a level that you do not care. You do not care what happens. It either works or it doesn't. Does not matter. Now, here's going to be the caveat. You can't just say you don't care. If you care when the trade gets, you say, I don't care what happens. And then the trade gets stopped out and you're having an emotional breakdown. Well, clearly you care, right? Sorry. But the point isn't that you can't trade this with more than 0.1 R risk. The point is, when you understand how to evaluate your trades over large sets, you have the confidence to trade it with some more size. That confidence doesn't come without experience and your own data, to where you say, I don't care. You say, this is my scalping data. I'm going to win half my trades. My average win is going to be 3.8, my average loss. And my longest loss streak is going to be 13 over, expected loss streak is going to be 13 over 500 trades, whatever it is. So I'm going to risk 0.5. And I understand what the risk of that trading system is. Now, the thing that people, this is why I want people to watch my risk management videos, where I go over like probabilities of loss streaks and all this stuff, that it's essentially inevitable you're going to run into long loss streaks mathematically. You can't avoid it. And my videos explain that math in such a way that I think just the average person can understand. Is being confident or not caring about a trade and the sizing you're losing can come from ignorance, right? If you're saying, oh, well, I don't mind risking 15% here because I know like I have a 50% win rate, and with 50% win rate, yeah, I might lose 15%, but my next trade I'll make 45% with my 3R. But that's coming from a bit of ignorance, right? Because your size way too big mathematically because you don't understand. It's the same thing like, I'll just give this quick explainer here because it's going to help some of you. Think of a coin toss. It's perfect 50-50 unless it lands on the edge, but it's 50-50 random. So you might say, yeah, I don't mind betting 20% of my net worth on heads landing if someone's going to pay me 3-1. I have a 50-50% chance I'm going to bet 20% of my net worth. You'll lose everything if you keep doing that, because what are the odds of it landing tails 10 times in a row? 5 times in a row at 20% risk? It's low. It's low. What are the odds of it happening if you flip the coin 200 times? Almost certain. It's almost 100%. So when you're even though you have a 50-50 coin, that's the probability of a series of events over large series of flips, right? It goes from 50-50 per toss to 100% chance that you run into essentially 100% chance that you run into a 5 flip loss streak. So if you're sizing at 20% per flip, even though you have a beautiful edge that could make you infinite money, you're going to lose everything because you're betting too big. Hey, but maybe you go in there and you flip at 1% risk and you keep flipping that coin, and your max expected drawdown, even over 1,000 flips, gets somewhere closer to like, or loss streak is somewhere closer to like 12 to 15. I'm not saying you can't have multiple loss streaks, right? You're gonna have 12 to 15, maybe you're gonna have a 7, you're gonna have a 5, but you're surviving those inevitable loss streaks. Yeah, and you're not protecting yourself against losing one trade. You're protecting yourself against the fact that even if you have a 65, 70% win rate, 75% win rate, you're going to run into these very big loss streaks. Somebody actually just posted, it's a newer member in the Discord, and seems like they're having some big breakthroughs. But they posted this in the public Discord, but they said, yeah, maybe I'll read this. I mean, I think it's all very good. It's all like good insights here. They say, they show a bunch of trades, some winners, some losers, what have you. Say, thank you for making me understand loss is part of game, as I always see in CT that everyone posts a win, so I wanted a strategy that I can win always, which is impossible, right? But a lot of people are just trapped trying to figure out, how can I avoid ever losing? You don't want to avoid ever losing. If somebody gives you 3-1 on heads on a coin, you don't care that you're going to lose sometime. You're just going to bet appropriately, right? You're not going to say, no, I want a coin where I only win 100% of the time. No, you realize, hey, if I get 3-1 on heads, I can just bet on heads and just bet small enough so that when I run into those inevitable loss streaks, it's not a big deal. I'll make infinite money. But nobody mentioned losses. So after you making me understand, no one knows what price goes up or down. It's just we manage to risk and trade the setup we get. I have 3 wins and 5 losses, but my wins are far better, which covers 4x my loss, which is better than my job. All trades were taken today. I started to accept losses, knowing it's a part of the game. I feel better now and confident. So one of the things that people think is that accepting that you're going to lose, taking trades that you think you're going to lose, is going to make you feel less confident. But the problem is when your expectations aren't met and you think that you're going to win a trade, you start doing really stupid things. When you start accepting you don't know if it's going to win or lose, you start managing your risk. You start accepting, I don't know what's going to happen. I don't know. There's no way to know. But I can still take this trade, get 4-1, 5-1 on my risk, and it either works or it doesn't. And if it works, great. But if it loses, then I'll take another trade and get 4 to 5 multiple on my risk. And if that wins, now I've paid for 5 losses, and I take another loss. Now I have 2 losses, 1 win, but my win was 5 times bigger than my 2 losses. You get the idea. And then somebody Roger, a new member, says, yes, indeed, grateful to Lucky for screaming it from every rooftop that losses come with it. How we manage the loss is the difference few get or seemingly ever come to grips with. And by the way, you'll never find a professional trader, even the most performant money managers in the world that have made billions and millions of dollars, wealthiest people in the world, say anything different than what I'm saying. Roger says, I'd come around some time ago to looking for the higher probabilities and probabilities, hedge accordingly, but didn't delve into the art of risk management and proper hedging. Until Lucky and watching the Mark Douglas video, I grotesquely underestimated the importance of risk management. I started paper trading and found a way to blow up what I started with while having a 75% win rate. It was truly eye-opening. So let's have a little conversation here about that. But the point is, it is like a light bulb moment, and it can be when you realize there is no way to beat the math. There's no way to beat the math. If you're not using appropriate sizing and risk management, you are just going to lose. Doesn't matter what your win rate is. If you're putting on too much risk, doesn't even matter what the risk reward is. I could say, well, I have an 80%, I have a 99% win rate. Let's create the perfect stats. I have a 99% win rate, and my risk reward is 100 to 1. Okay, that's pretty good. You shouldn't be losing money with those stats. But there is a sizing that you can trade with that. I mean, your best bet would just be, if you're going to go all in, do it a few times and then make a ton of money and quit trading forever. But if you trade that system long enough with the wrong sizing, you're 100% certain to lose your money, right? So the sizing is really important. All it takes is one if you are sizing appropriately. And so here's another thing that's really frustrating. It's not frustrating. I guess it's just frustrating to share ideas. So there was a time where, in the Discord, for example, where I only shared, and it was maybe a little bit patronizing, where I just only shared what I considered the highest probability win rate wise, right? Trades that I was taking. And I would have these really long win streaks. I had some conversations with some Discord members, and there's a lot of experienced ones in there where it's sort of patronizing, because it's sort of like saying, because they ask, like, why wouldn't you take this trade? Why wouldn't you take this trade? It's like, I would take those trades, but it's like, I'm not saying that the Discord members aren't retards, but it's like talking to retards sometimes when you have new members that don't understand a concept. So, for example, let's just say I have a coin. I have this coin that I can flip, and it pays me 10 to 1, and it has an 80% chance to land on heads. Let's just imagine. Yeah, I want to flip that coin. But I have another coin that pays me 3 to 1, and it has a 50-50 chance to land on heads. I still want to flip that coin, right? So there's different types of setups where it's EV positive to trade. Even there are coins that have a negative, a sub positive win rate, not a negative win rate, less than 50%, that are EV positive to trade. If you have setups that have a 30% win rate, but they pay you 20 to 1, you have some 20 to 1 setups, 30 to 1 setups, you just take those trades, even if they're less than 50% odds of working. And so, I had some conversations, and people said, maybe it's okay if I probably should focus less on just high win rate, because it's sort of misleading in a way for what you should be looking for as a trader. You're looking for positive EV. You're not looking for the highest win rate. So, yeah, I think overall it's been good over the last little while since I started. I think the general reception has been good, focusing on higher frequency setups that are EV positive with risk management. If people don't want to use risk management, they're not going to succeed anyways, right? So hopefully that makes sense to you guys, which is just if we imagine the coin, I'm just going to touch on this one more time. If we imagine the coin flip scenario, if somebody says, hey, I have a coin flip deal for you, I give you $3 for every dollar you risk, if you get heads and it's a 50-50 coin. You don't say, no. I can't do a loss. I can't do a win rate of 50%. You're gonna have to swing that deal on me, baby. No, you say, okay, I'll bet on that coin. You're betting on that coin with this guy. Another guy comes and gives you a coin that gives you 2 to 1, 50%. Yeah, sure. I'll bet on that one too. I know how to size that. If some 7 to 1 coin guy shows up, you say, yep, I'll take that. But anyway, so just saying that people get too caught up on trying to think, I only want to take this short if I think it has like a 99% win rate. Well, what's the idea? You know, targeting back into these lows. Maybe you're getting 10 to 1. Maybe you're getting 11 to 1. How good does this win rate have to be EV positive to take this short? It's already at 1R. Whatever. How good does this have to be? A lot of times you're going to be able to get out of it, break even on setups like this, but it doesn't matter. That's not the point of what I'm saying. If you could get 10 to 1 on your risk, the setup doesn't have to be very high probability to be EV positive if this plays out. It doesn't have to be. It could be less than 50%. It could be less than 30%. But maybe you want to size it a little bit smaller, right? I want to put on a little bit of risk. I just want to put on a little bit of risk. It's either going to work or it's not, but I could trade this 10 times and win it once, and it's break even. So that's okay. I don't mind that. So Michael says, I have a system where I reduce risk by 50% after 3 streak loss. So, you know, when people ask me like what my thoughts are on anything like that, I can share what I do and what I think, but I think do what works for you. There's a lot of traders, really successful traders, money managers that have an idea of where they reduce size as they lose more trades. For me, 3 is like not something I would change anything, because it's like I'm expecting to run into 3 trade loss streaks all the time. I mean, it's not a big deal, but it also depends what the size you trade is. Ricardo says, I created an account with your Rollbit link and I already made a deposit with this. Can I enter your Discord group? Well, you enter the Discord group, you have to pay to enter the Discord group. As far as the Rollbit, I have nothing like if you use an affiliate link. I'm not even a partner with Rollbit or anything. I mean, I left the link in there. I don't even know I don't even think I get anything. I don't even know what I get. All I know is that I've gotten $4 and I don't know what it's come from over the last like 8 months from Rollbit. So, but anyways, it doesn't really matter. It doesn't matter if I was a partner with them or what not. It's nothing to do with joining the Discord. All right. Well, you know, just trying to see if I want to stay on here much longer. Okay, somebody says, hi, Lucky, after paper trading for a bit, do you think trying out the live markets with spot or perps with 1x leverage is better? My goal right now isn't to make money, but rather to get the feel of using real money. So just a couple things, you really should understand this before you start live trading. Leverage has nothing to do with risk. I could be 10,000% leverage here and have less risk than if I was 1x spot, right? We're thinking about position sizing. So let's just say, like, for example, I mean, I did that Rollbit scalping video. So like a 500x leverage position up at the highs here. This is my stop loss. If I'm 500x leverage here and then my stop gets hit and I lose my margin in that position, can we think of how it would be possible that I could still have less risk than if I just had a 1x position here with a stop here? It's about sizing. If I have a $20 million position here and price goes up 0.2% at 1x, or I have a 300K position at 500x, my risk is smaller with 500x, right? You always want to be risking based on your like you have your technical setup. Your leverage has nothing to do with your risk, right? It's all about how you're sized. But that doesn't mean start using super high leverage. I'm just saying that it doesn't have anything to do. You can 1x leverage can be incredibly risky, and most people lose money trading with no leverage. So what I would think about is sizing. So let me just, I'm not giving you direct advice, Chris, about like what you should be trading, how you should be trading it, but I don't know your financial situation, but I understand the question you're asking. So let's say that you want to start trading with live funds. Maybe you want to get the feel for an exchange or with having some risk in the market. Let's imagine that, you know, for you, a decent sized trading account was going to be $1,000. Like that's kind of what you want to trade with, but you wouldn't want to lose it. But that's what you're imagining. Like if I started trading right now and I thought I was profitable, I can imagine I have this $1,000. I don't want to lose $1,000 though. Have had some success with paper trading. Maybe what I'm going to do, and this is going to sound really boring to you, is I'm going to put $30 into a trading account. And I'm going to divide my trades into 1% risk. So I'm talking 3%. Your entire account is 3%, and you're going to treat that $30 like a real trading account. You're only ever going to risk 1%, right? Or whatever the numbers. I'm giving an example. Maybe you want to have a $10,000 trading account. You have that capital available. Maybe you start with a $100 account. Now you start taking trades with that small amount of money. If over a large sample of trades, you're like, hey, things are still going really well. I'm still trading profitably. I'm getting more and more data. Bump up the size of your account a little bit. Now you've traded your $30 over a series of 50 trades. You're doing well. You're managing your risk. Now you're bumped up to $100. Everything's going really well. You know, you're up 70% on that account. Your max drawdown is this. Blah 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 blah. Maybe you bump it to $200. And the reason I tell people this this kind of idea is you can become a trader with no risk. Start essentially no risk, with very low risk. Start paper trading, develop just the practical technical skills of trading, the practical knowledge. How do I size my trades? Why do I size them this way? Like if you're a brand new trader, you don't know anything, you don't need to put money at risk. There's so much to learn without needing to have money at risk. Once you understand the basics of what you're trying to do, you have some consistency with paper trading, put a very small amount of money. If that goes well, make it and this can happen over a short amount of time. And by the time you're up to that $1,000 account, you've ran a $30 account up, you've ran a $100 account up, you've ran a $200 account up. And maybe what happened when you went to a $300 account, you went to a $300 account and you kind of started running into some roadblocks. You notice, whoa, my execution has fallen off a cliff. I'm not taking the trades I used to take. I'm more afraid. Maybe I'm more greedy. I'm thinking, oh, if I just size this up a little bit bigger, I'm not staying disciplined, and I just blew up this account by 20%, 30%. Maybe you have some kind of system in place. I'm going to go back down to the previous size. And here's the point of this. You can be very risk averse. I know it sounds boring, but if somebody doesn't want to lose a bunch of money learning how to trade, this is how you do it. And so this is what happens. Either you never consistently are profitable, in which case you're not consistently scaling your account. Every time you do a series of 100 trades, let's say, and you're not EV positive, so you went to the $100 account, you're not EV positive, you're down 27%, so you've lost $27, you go back to the $30 account. And you just keep going back and forth. But the point is, by the time you reach your $1,000 account or your $10,000 account or your $100,000 account, you now have a personal track record of being a profitable trader with live funds scaled all the way up to that account. Your own data, and do you think you're going to be a pretty solid trader at that point? But what do most people do? Most people never traded before in their life, don't even understand what leverage is. They put their life savings into a trading account and they start firing off trades with insane risk, and they're surprised when they lose everything. I tried trading. It went really bad. It's like, yeah, I bet. So, yeah, I mean, that's the approach I would take. The market's not going anywhere. You're going to be such a solid trader if you take that approach. It's boring, it's a grind, but it's like you are dissociating big money. I'm going to make big money from your trading from the get-go. It's like you're just executing trades, scaling up your risk slowly. Yeah. So that's what I would think is a good way to approach it. Yeah, so I'm just reading your next comment here. You say, I plan on using a very small portfolio size, so that's great. That's kind of what I said. And small risk per trade, like 1 to 2.5%. Let me make this clear. That's not small risk. That's standard risk. 2.5% is very high. I'm just saying, like, any professional trader is not going to be like, oh yeah, that's really small. I mean, no, you're gonna be running into like 30-40% drawdowns probably, especially as an inexperienced trader. So just saying, it's not low risk. I have nothing. I have no idea. Someone's saying I've read shady things about rollbit withdrawal. Have you ever heard similar experiences, or what's your withdrawal experience? I haven't had issues, but I don't vouch for any exchange. I mean, I used rollbit specifically because it has a really good fee structure for scalping. But the as far as withdrawal issues, like people have said the same about Bybit. It's like, I really like Bybit. People told me, I've read so many things. People can't get their money out. It's like, well, I'm not doubting those things can happen. I mean, they're pretty much stories like that about every exchange. But I also like to manage exchange risk, which is why I use leverage. I don't want to put all of my funds on an exchange at any given time. Scrolling up, for some reason I think there was something, but maybe I missed. Maybe there wasn't. I might end the stream here. So let me go over kind of my general plan on Bitcoin here, more or less. Price is ranging. Could be kind of interesting. We just had 14.3 million negative delta here. Just show that really quickly. Kind of interesting to see what happens up at these local highs. Some of this liquidity is starting to get wiped out here. But the general idea for me locally, I'm not going to go over all the high time frame stuff, I've covered it so many times, is I'd be kind of interested in 2 scenarios, 3 scenarios, and this is another thing. So plan your technical setups, but you can have ideas for longs higher, longs lower, shorts higher, shorts lower. Is if we start forming something like this with bullish absorption, come retest these lows, take maybe this local low, wipe out all these longs. Yeah, I'd be interested in saying, hey, this is a range. For the same reason, I'd be interested in shorting into the local highs. Maybe a sweep of this low. Retest would be kind of clean here. Maybe we would form a range. Long up into these highs, short here. We have a GP above. Very similar. I mean, if you remember, it's like literally, where's the setup here? Yeah, I think it's literally just this setup. No. Let me go to the 15-minute chart. Or 30-minute chart. Well, I went full tard there. I was zoomed so far back. I'm like, what the hell is this structure? It's just this setup. Come wipe out all the downtrend liquidity. Wipe out all the downtrend liquidity. Go to the 5-minute chart. So back here, if you're a member, you'll remember this idea. We're kind of ranging in a downtrend here. We fake out the downtrend breakout. I had the idea of longing into this, but we end up wicking the low into the New York Open. This is back last week, 5-6 days ago. This is a 5-minute chart. But then the idea was to run back up. So fake out the breakout, retest this local liquidity. This was the short setup, if you recall. And this was a nice long setup into the lows. But basically the same idea structurally, right? You have this downtrend, fake out the downtrend breakout, come retest the lows. Maybe we wick the low too. That's kind of an idea. Higher low, wick the low. Both of these ideas in this context can happen for this kind of bullish scenario locally. Come wipe out this liquidity above, short setup, back into the lows, and maybe come and take these lows again. But can we see, it's funny that I scrolled so far back. It's like, in my head, this was not 5 days ago. But let's just look at the general premise of the setup. There's some consistency here for technical structure. Although the scale of it's a little different. Low, 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 breakout, fake out, up, take the liquidity. Could probably even make that a fractal. This is the fractal. Although we wouldn't quite take that high, but I like pushing up a little higher, but I guess you could watch all these highs too. But yeah, so we're basically here on the idea of the fractal. Take out the trend line with it, one fake out, maybe come back, retest it, maybe wick this low, rally into this something in the New York Open. That could be a short setup. It's not identical, but it's pretty close. I like taking this high though. The difference here, like why would it use the fractal for the short setup? Although one can easily see how this is just going to be another SR flip. So this is probably worth watching. Check out order flow here. It's just the structure's a lot different. This pivot high is a little bit cleaner than this. You know what's funny? This is almost the identical. It's just like a really condensed version of the exact same price action. We even had this with like this little like wick up before the sell-off and the little local SR flip. Like we have this little range with the little wick sell-off. It's just, it's like an identical fractal almost for just this, the basic idea. The initial sell-off, little range, wick up. All right. Yeah, so for someone says they're a new member, they've been struggling with risk management. I'm telling you, I know it sounds boring. I'm considering renaming risk management to infinite money sizing. It's so important. You have to go over all of the risk management videos in the members' educational content. Like there's 0 point in trading without it. Understanding that stuff. Yeah, you know, it's really not like so I'll just say Chris is saying, got it, thank you so much. We'll use an account size with an amount of dollars insignificant to me and run it up while learning along. We'll use lower than average risk too, like 0.5, 1.5. Yeah, and that's a great sizing. It's not about like you want to kind of standardize things. It's like if I have a trading account and I'm risking 1% per trade, what are the results? I'll just, if $30 is an insignificant amount to your $50 or $100, whatever the insignificant amount is, that's your trading account. You're going to risk $1 per trade, and you want to see the stats. You know, like there's I think it's a Paul Tudor Jones quote. He's worth $9 billion, a really performant trader, and primarily a technical trader. But he says it doesn't matter if you're trading a $100 account or $100 million account, and if you're doing 50% returns, you're doing 50% returns. Now, of course, there's going to be some random person. There's a big difference between having a data set of 5,000 traders and some random trader, their first day trading, said, I went 500x leverage long here and I have 6,000% in my account in one day. Why aren't I on the front page of every finance magazine in the world? Why is Paul Tudor Jones? This guy made 30% last year. I made 6,000% on my first trade. Obviously, you should understand why some random person that just long bought a shit coin, it went up 1,000,000%, isn't considered a better trader than somebody who's consistently done 60% a year for 30 years and never had a down year, or in some cases a down month in 30 years. So it's about risk, reward, consistency. If you're risking everything on every trade you take, but your first trade hits a home run, nobody really cares, right? Because nobody's going to give you money. Nobody's going to give you $5 billion to manage if that's how you're trading. What people want to know is that you can consistently pull returns out of the market with minimal risk. That's all that matters. Okay, I appreciate everybody tuning in, and that's all that matters for a trading career. I appreciate everybody tuning in. Hopefully this was valuable. We'll see what happens. Maybe I'll get some updates out here